Well, US markets are taking a deep dive and tech stocks are seeing the biggest losses. The Dow plunging by 1,000 points, wiping out Wednesday's gains. And this all follows the Federal Reserve's announcement that it was raising interest rates by half a percentage point. To unpack all of this, business editor at large Richard Quest joins us now live from New York. So, Richard, the market's on pace for what could be the worst day since 2020, certainly the worst day so far this year.
Absolutely, and it's not surprising in a sense because the economics underneath this are just getting awful. We've got inflation that is high and will remain stubbornly high for the foreseeable future. You have high gasoline and fuel prices, largely on the back of what's happening with Russia and Ukraine. And even though OPEC said it's going to pump more oil, that's still creating an underpinning of that. Higher oil prices, higher gas, that slows down the economics more, makes companies less profitable. What you're seeing, Lynda, is a repricing of assets such as stocks and bonds. And the view now is that a recession is growing more likely in the United States and certainly more probable in the United Kingdom and in Europe. And the market can no longer support the very high prices that we've seen. There is more of this to come.
And of course, the Fed is expecting to increase interest rates as it deals with the worst inflation in 40 years here in the US. How long could it take until inflation gets to healthier levels? And you mentioned a recession, of course, being one of the risks.
We're talking about a recession probably mid to late next year. There's something known as the monetary lag between when they move on interest rates and when consumers stop spending and things like that. But there's also another effect that we also talk about, which is the wealth effect. And people going home tonight, seeing the market down 1,100 points, and then realizing that they are poorer, and not only that, they are spending more on fuel, on food, on education, on all those sort of things. So all the discretionary money, even that which people had saved because they didn't do anything during lockdown, that is now going to get eaten up by higher charges. Take, for example, the UK, which I know you'll be talking about, where interest rates went up and where mortgages will be going up because of the relationship. They're much closer tied. When one goes up, the other goes up. Credit card repayments will be going up. Bank loans will be going up. The weekly shopping bill goes up. And that creates a feeling of people being unhappy with what's happening in the economy, not spending. And you start this downward spiral. And the reality is, and the irony, this is what the policymakers want. They want to cool the economy down to such an extent that inflation comes down. It's economics 101, but you don't want to tip the economy into recession. That's becoming less easy to do. It's almost likely that we'll have recessions on both sides of the Atlantic.
Yeah, certainly a tricky balancing act. Richard Quest, as always, good to have you with us. We will tune in to Quest Means Business very shortly. Thanks so much.
Okay.
Well, in the UK, as Richard mentioned, inflation is rising. It could rise 10% this year. And a recession might be on the cards there too. That dire warning from the Bank of England. UK interest rates are at a 13-year high, increasing to 1% as the country battles with its cost of living. Well, CNN's Anna Stewart joins us now from London to discuss. So certainly the Bank of England, Anna, raising interest rates to combat the worst inflation in some 30 years. And of course, we're hearing that the UK is facing a sharp economic downturn.
Yeah, the picture over here on this side of the Atlantic looking just as gloomy, frankly, as Richard was talking about in the US. So the central bank decision from the Bank of England was as expected when it comes to the rate hike, bringing it up to 1%, a small 25 basis point hike. But it was all the elements around this, particularly with the outlook, that were unexpected, that did shock investors. First of all, just how gloomy the inflation outlook is now. As you say, it's expected to actually top 10% this year. And then there were the forecasts for GDP. Now, for this year, the Bank of England thinks the UK will grow at 3.75%. That was as before. But it's next year where it now sees a contraction of a 1/4 percentage point. So you have high inflation. You've got an economy either in recession or pretty much at a standstill. Double whammy. You're looking at the spectre of stagflation here, which is always the big concern. Also, Lynda, there was a split on the Monetary Policy Committee vote that was quite interesting for investors. 3 out of the 9 actually voting for a bigger hike of 50 basis points this meeting, which was quite interesting. Almost a hawkish tone. but only in the near term, given that very gloomy economic outlook going forwards. The pound dropped some 2% against the dollar on the news. The FTSE 100, therefore, closed ever so slightly higher, so no big sell-off here. And bond yields actually fell, which isn't what you'd expect normally with a rate hike, but that's because looking forwards, investors are thinking maybe there won't be as many rate hikes as expected. And so much of the forecasting for central banks right now is incredibly difficult because so much rests on inflation. And how baked in is that? So much of that rests on energy prices, and so much of that, of course, rests on the situation in Ukraine and sanctions on Russian energy. Lynda?
Yeah, certainly a lot to deal with to bring that inflation under control and not end up with a recession. And Stewart, good to have you with us from London. Well, German prosecutors say they're sure that they've caught the man behind the disappearance of British toddler Madeleine McCann after new evidence has emerged in the 15-year-old case. We'll have that story next.